In last 1 year, Indian markets have seen it all. Financial year FY12 started on a high note. Then we saw some mid-year turbulence, courtesy global concerns, and a strong and unbelievable liquidity-driven rally is what has surprised all of us in last 3 months. But what are the key assumptions for FY13? The story for FY12 was benchmark indices were down and individual stocks, they did manage to outperform. Will that same theme continue this year as well? More on that with a very special guest on the show, Naval Bir Kumar, Chief Executive Officer of IDFC Mutual Funds. Naval, what a delight to have you back. Thank you for joining us. Naval, in the last 3 months, we've seen deadly volatility, intense price action, and markets have indeed managed to climb the wall of worries. So what exactly is happening?
I think you summed it up fairly well. We started the year well. We ran into fundamental headwinds. Then we had a very unprecedented liquidity injection, especially in Europe, which revived markets considerably over the last 3 months, took everybody by surprise. And we've ended the year 9 to 10% lower from where we started it, but much higher than what most people anticipated we would end it. So fundamentally, I think the economies still look a little fragile. They're driven by significant liquidity injections. So since the first LTRO injection by the Europe Central Bank, you've now had a second one in Europe. And the US has indicated many times that they're willing to inject further liquidity if the situation so requires. So with liquidity remaining exceedingly large in world markets, you clearly have a flow on asset prices. But you also have, to some extent, a ceiling given the the low fundamental strength in world economy today. So it's a very interesting trading zone, and like we say, as fund managers, we run 2 types of funds. One are pure alpha funds, and second are far more closely benchmarked funds. This is the period when the pure alpha funds will tend to outperform their cousins, which are benchmarked. And in fact, we have possibly the most interesting pure alpha fund in Premier Equity, which has now completed 5.5 years, remarkable performance over that period of time. And that's the fund that we are sort of backing, and we have in fact opened it for subscription. That fund is usually not available for purchase, so it's just been opened for sales today. So that's our view on, short view on markets looking forward.
So the story of how Indian markets moved in the year FY12 was largely dominated by liquidity, news from Europe, and then news which came from US economy. What, to your mind, will influence the script for FY13?
Okay, 2-3 things. Basically 3 drivers to growth. Outsourcing, which is the IT technology world in India, and that is looking good because it's got like you said, the US economy seems to be recovering, and that's positive for the IT industry. 2, a weak rupee. Balance of payments looks tenuous in India, and hence the rupee will remain under pressure for most of the year, which is positive for IT. And 3rd, financial services is hiring much less. So salary increments are lower for IT industry, and attrition levels are lower, and hence margin pressures are lesser. So IT looks good. The second big driver for growth is consumption, which is continuing to look exceedingly strong given the high fiscal deficit that the government is running. It's a process that was kicked off in 2007, 2008, when the government's borrowing was in the region of 1,50,000, and it's now 5,70,000. So we have seen a 4-fold increase in government borrowing in the last 5 years. A lot of that goes into social spending, a lot of that into the rural economy and into middle class. So with increasing per capita and aspirational spending, consumption remains exceedingly strong, and we think that theme will continue to play for this year. The 3rd is the investment economy, which I believe after the policy framework changes that started in 2000 is now structurally on a growth path. So whenever there's excess global liquidity, capital flows, interest rates are low, you will get a positive investment cycle. But the investment cycle currently is going through a cyclically weak phase. We've had, if you look at from 2006 to 2011, there's been nearly a 5-fold increase in fixed asset by the BSE top 200 companies in India. So that's a massive investment thrust over the last 5 years. You're now going through a period of restructuring and a period when those assets will start generating revenue. So you, in this period of time in the investment economy, you want to play developers who are very strong, who have projects that have started to generate cash flow, whose debt on balance sheets is controllable, and who we believe will lead the next investment cycle. So right now, if you can pick the winners for the next investment cycle that will start 2-3 years from now, when interest rates have bottomed in India, I think you'll make a lot of money.
Which is the best way to maximize returns when liquidity is cheap?
When liquidity is high, you've got to play stocks that are in interest. I think 2012-13, the current year that we have started, is going to be the year for stock picking. So like I said, this is the year for alpha rather than beta. I think that the overall indices will remain range bound. So they will have a flow because fundamentally the economies are weak. So whenever the global situation looks a little weak and we get negative flows into India, you will see corrections in the Indian stock market, but driven by a flow, because at some point of time, India being a high growth story, you'll see money come back. On the other hand, given that fundamentally we still are fragile, I think there's also a cap. So this is a trading environment. So you've got to play stocks that fundamentally are going to look good and going to be well positioned for growth over the next 3 years. And individual stocks, I think, will do remarkably well. So while the index may be range bound, you could have, individual stocks that may double in value over the next 36 months quite easily.
So if I look at your last declared portfolio, you've sold Titan, you've reduced your exposure to Blue Dart, you've sold Excite, but you've increased your exposure to cement and some power companies. Why is that?
You're talking of Premier?
That's right.
Okay.
Your flagship.
Yes. Basically, we played consumption for the last 3 years, clearly driven by the change in the spending patterns of the economy, because most of the spending was not coming out of the investment economy, but the spending was coming out of the fiscal deficit of the government of India, and a lot of that was going into social spending and hence feeding into consumption. So we played that. A lot of those themes have become fairly well priced to being expensive. So we've trimmed profits in some of those. We are not saying that those companies are not going to continue to do well, but we think a lot of that future profit is already in the current price. So we've trimmed that a little bit. We believe that the investment economy has corrected significantly to the extent that is very interesting if you can pick the winners for the next investment cycle. And if you can pick them, I think they do exceedingly well. So we have hence increased focus on the investment economy, knowing fully well that it's going through a phase of consolidation, but the potential winners are far more visible in the investment economy. And lastly, in financials, we're clearly playing the retail financial theme, because while a lot of corporate balance sheets are over leveraged, household balance sheets are significantly under leveraged, employment remains strong, and hence the focus, we believe, in banks will shift towards consumer finance. And there are clearly a few entities which are better positioned to capture that opportunity than a lot of others. So we've refocused balance sheets in the financial services sector.
Now, if I look at again your last declared portfolio, you're bullish on investment, but you still don't own banks. Banks are the first one which fund managers normally like to load up when they're bullish on when they're bullish on economic growth.
Okay, I can explain that quite easily. See, like I said, we look at themes that run through the Indian economy. So the investment theme started in 2004-05. It's a global theme. It runs across world economies. India participated in this investment theme, did not participate in the 90s investment theme that led to the Asian crisis because policy framework was not in place. At the start of an investment theme, we then look at the profit pools in that theme. So at the start of the team, there were 4 players. One is the equipment providers, the developers, the financiers, and the mineral providers. These are the 4 themes that are linked to the investment economy. So during the construction phase, the financiers do exceedingly well because they have very high rapid credit growth, but no risk to capital because it's all in the construction period. The equipment manufacturers do exceedingly well, and the developers, they may get priced expensively because of order book sizes and size of balance sheets, but you need to be very careful to determine which are the ones which have strong IRR generating projects. The mineral providers start kicking in once the projects start becoming operational. So we hence prefer to play financiers in the first part of the theme, and in fact we were one of the only fund houses that did not come out with an infrastructure debt fund, equity fund, even though we were IDFC, because we didn't think it was sensible. We launched our infrastructure equity fund a year and a half back, more when you had a collapse in infrastructure prices driven by the end of that investment economy, and a shift hence away from financiers, a shift away from equipment manufacturers, a shift into those developers which have well constructed high IRR projects which are becoming operational, and to some mineral providers which will fund hence the operationalization of those assets.
So where do we stand now right now?
So we stand at the cusp where a lot of capacity that has got invested in the last 5 years is starting to come on stream. So in the next 3 years, a lot of those capacities will come on stream, and those capacities will have a knock-on effect on growth in the Indian economy as supply, as more roads, more power lead to more economic growth across other sectors of the economy. So within infrastructure, we would rather play developers right now, but like I said, those developers that are strong will actually lead the next investment phase and have good quality, high IRR generating projects on balance sheet today and low relative debt, correct? And we would start selectively playing the mineral providers right now. But in the financial services sector, we would shift away from infrastructure financiers into consumer finance, simply because the household sector over the last 3 years has actually got under-leveraged. And we believe, given the consumption trends, that you will see much more growth in consumer finance over the next 2 years than you will in corporate spending or corporate finance.
But by and large, this year, are you in a buy mode or are you in a sell mode?
In Premier, we are in a buy mode, clearly, which is why we're raising money, and that additional capital will go into the new ideas that we have. In the large cap diversified, we will hold portfolios in the current year, and in sterling we are clearly in buy mode, because again, a lot of opportunity in the mid cap space. Like I said, this is a year for alpha. This is not a year for benchmarking. Benchmark funds will sort of be in a trading zone. Clearly a year for alpha.
So are you negative on consumer stocks because they're expensive, or you see discretionary spending could also come under pressure? It could be a function of high service tax, it could be a function of high inflation, it could be a function of high interest rates.
There are beginning to be some headwinds to the consumption space, but given the large fiscal deficit, we think that space continues to show high growth. So within that, we look for stocks where return on equity is still high, but price earning ratios are not fully pricing in the growth in earnings. So we really don't have an issue with the consumption sector. We think the consumption sector continues to do well. It's got a huge number of significant tailwinds behind it. What we are a little wary of is the valuations in that sector. And we think that you could be in a situation exactly where the investment economy was 5-6 years back, where you get unreasonable valuations, right, which normally tends to happen in every cycle. So you're not at unreasonable valuation levels, but you are at more or less fully priced in a number of stocks. So we're just being careful. We want to see if the market starts moving into unreasonable valuations, or whether the market will pause here. So that depends on the quantum of money that continues to flow into equity. So we want to examine that.
So consumer stocks, to your mind, are trading at unreasonable valuations?
The headline ones are fully priced. They're not unreasonable. They're fully priced.